All right, let's jump right into a chapter that is absolutely guaranteed to show up: tax invoices under GST. Mastering the tiny details here can seriously be the difference between a pass and a fail. So let's get right into it.
Okay, let me throw a question at you. One that feels like it's straight out of an ICI paper. It seems simple, right? A small sale, an unregistered customer. But I'm telling you, this is a classic trap. The answer, whether it's yes or no, all comes down to a very specific rule we're about to unpack.
And I'm not kidding here. Getting these details right is what separates the top scorers from everyone else. So let's break this chapter down piece by piece so you can confidently handle any curveball ICAI decides to throw your way.
So why all this fuss about a simple bill? Well, because in the world of GST, a tax invoice is so much more than that. It is single-handedly the most important document you'll deal with. Think of it as your golden ticket, your all-access pass to claiming input tax credit, or ITC.
And this right here is the heart of it. Straight from the law. No invoice, no ITC. It is that black and white. This is exactly where marks get lost. See, if you're a business and you don't have this piece of paper, you can't lower your tax bill. It's a direct hit to your bottom line. So the main takeaway? The invoice is everything. Okay, before we dive into the nitty-gritty of Section 31, we need to make sure we're all speaking the same language. Not just the language of the law, but more importantly, the language your examiner uses. Getting these definitions down cold is absolutely crucial.
First up, we've got credit notes and debit notes. Now, for now, just think of them as correction documents. They're issued under Section 34. We'll dig into that section in detail later on, but it's important you recognize these terms when they come up.
Next up, continuous supply of goods. A perfect example is a pipeline supplying gas or a factory getting daily deliveries of raw materials. The two key phrases you gotta remember are recurrent basis and periodic invoicing. And notice something important. There's no mention of a specific time frame here. Now, let's look at the continuous supply of services. This is similar, like an annual software maintenance contract. But here's the twist, and you've got to watch out for this. The law is very specific. The contract period must be for more than 3 months. This is a huge point of difference. And looking at them side by side really drives the point home. For goods, it's all about that recurring pattern. For services, there's a hard and fast time condition, more than 3 months. I cannot say this enough. ICAI absolutely loves to build case studies around this tiny difference, so please make a note of this. All right, let's just quickly tick off the last few definitions here. When we say invoice, we mean the tax invoice from Section 31. Exempt supply is a broad term. It covers nil-rated, fully exempt, and even non-taxable stuff. A document can be on paper or electronic, and a quarter is just your standard 3-month block ending in March, June, September, or December. Simple. Okay, definitions are sorted. Let's get into the main rules. We're starting with Section 31, subsection 1, which is all about the supply of goods. And when it comes to goods, let me tell you, the timeline for issuing that invoice is super, super strict. The law gives us 2 clear scenarios. First, if the supply involves goods actually moving, say from a factory to a warehouse, the invoice has to be issued before or at the very moment the goods are removed. The key word is removal. Scenario 2. If the goods aren't moving, maybe it's a huge machine you're selling that's already on the customer's property, then the invoice has to be issued before or at the time of delivery. The key word there is delivery. Notice what's missing. There's no after option for goods. It has to be before or at the time, period. Now let's flip over to services, which you'll find in Section 31, subsection 2. The whole mindset here is different. Forget this strict deadline we just talked about for goods. For services, you actually get a bit of breathing room, a window of time to get that invoice out. So the big takeaway for services is this flexibility. You can send the invoice before you even start the job, or you can send it after you've finished. But, and there's always a but, right? If you issue it after you're done, you have to do it within a specific time limit that the rules lay out. Okay, let's put these two next to each other because I promise you this is a gold mine for exam questions. For goods, it's a strict deadline, on or before removal, no option for after. For services, it's a flexible window. You can do it before or after, as long as it's within the time limit. Examiners love to blur these lines in a case study, so knowing this distinction is essential if you want those full marks. So we've nailed the general rules for goods and for services. Now let's dig into some of the special cases you'll find under Section 31, subsection 3. And this is where we're finally going to solve that mystery from the start of our session, that one about the 150 rupee sale.
First up is something called a revised invoice. This is a super helpful tool for anyone who's just gotten their GST registration. Picture this. You were supposed to be registered from April 1st, but you only got your official registration certificate on April 15th. What about all the sales you made in between? Well, this rule lets you go back and issue a proper revised GST invoice for all those sales. This is great because it means your customers can now claim the ITC on those purchases. You've got 1 month from the date you get your certificate to issue these.
And now, for the answer you've been waiting for. The magic number that solves our opening puzzle is 200 rupees.
Here's the rule that cracks the whole thing open. A supplier can choose not to issue a tax invoice, but only if all 3 of these conditions are met. Not 1, not 2, all 3 have to be true. 1, the value is less than 200 rupees. Our sale was for 150, so check. 2, the customer is unregistered. Ours was, check. And 3, the customer doesn't ask for an invoice. Our customer didn't, so check. Because all 3 conditions were met, the shopkeeper was not required to issue a tax invoice for that particular sale.
But hold on, if you stop there, you're leaving marks on the table. Answering no is only half the story. To get full marks, you have to mention the other part of the rule. For all those little sales where individual invoices weren't issued, the shopkeeper must prepare one single consolidated tax invoice at the close of business each day. That's the complete answer.
Okay, let's just jump right in with the classic exam-style problem. Imagine this. Your business hits the threshold and becomes liable for GST on September 3rd. You do everything right, you apply on time, and you finally get that shiny new registration certificate on October 5th. But what about that sale you made on September 10th? You know, right in that awkward gap period. Can you just issue a regular tax invoice for it? This is a huge point of confusion, and we're going to clear it up right now.
Okay, so that big question we started with, let's tackle it head on. This situation is what I call the registration lag trap. And trust me, there's a specific tool designed to get you out of it, the revised tax invoice. So you might be wondering, why do we even need this special document? Well, it's all about building a bridge over that registration gap. See, your registration is effective from the day you became liable, not the day you got the certificate. This document is the key that lets you go back and properly invoice for that period. And this is crucial. It allows your customer to claim their input tax credit, their ITC. Without it, they lose that credit. And that's a big problem.
Okay, listen up, because this timeline is where so many students lose easy marks. You become liable, you apply within 30 days, then you get your certificate. The moment you get that certificate, a new clock starts ticking. You have exactly 1 month, just 1 month, from that date to issue revised invoices for all the sales you made in that gap. Miss this deadline and it's a major compliance issue.
And here's a super simple tip, but trust me, it could be a free mark in your MCQs. It's not enough to just issue the right document. You have to clearly, prominently label it as a revised invoice. It seems like a small detail, but in the world of GST, these details are everything. Now, you're probably thinking, what if I made 100 tiny sales to unregistered customers in that gap? Do I really have to issue 100 separate revised invoices? Well, good news. The law gives us a shortcut, the consolidated revised invoice. But, and this is a big but, be very careful with the conditions. It's only for intrastate supplies and only to your B2C or unregistered customers. Also, notice this. The value of the supply doesn't matter for this particular rule. All right, so that's how you handle things from the get-go. But hey, we're all human, mistakes happen, right? So what do you do when you've already sent an invoice, but the value is wrong? Or you charge the wrong tax? This is where credit and debit notes become your best friends. This is the absolute core of it. You have to get this right. Think of it this way. Did you charge too much, either on the value or the tax? You issue a credit note. It reduces your tax liability. Did you charge too little? You issue a debit note. It increases your tax liability. Credit goes down, debit goes up, simple as that. This concept is a guaranteed exam topic, so make sure you've got it locked down. So when exactly do you pull out the credit note? The law gives you a clear list. You charged too high a value by mistake, you applied a higher tax rate than you should have, the customer returned the goods, or maybe the goods or services were just not up to par, they were deficient. These are your 4 main triggers. And here's a classic ICAI move. They love using different words for the same thing just to see if you're paying attention.
A debit note is also known, legally, as a supplementary invoice. They might throw that term into a question to try and confuse you. Don't fall for it. A debit note and a supplementary invoice are the exact same thing.
Now, if you get a descriptive question, you'll probably need to list the details that have to be on these notes. It's pretty straightforward stuff. Your name, address, GSTIN. You need to state clearly if it's a credit or debit note, give it a unique serial number for the financial year, the date of issue, and of course, the customer's details. It's an easy list to memorize for some quick marks.
Okay, let's talk about a special situation. What happens when a customer pays you in advance, pays you upfront, but you haven't actually supplied the goods or services yet? You can't issue a tax invoice. So what do? You issue a receipt voucher. The key thing to remember about a receipt voucher is all about the timing. You issue at the moment you receive the money, not later when you actually make the supply. It's your official proof that you've taken an advance payment.
So what goes on this voucher? It's not just the amount of cash you received. You also have to mention the rate of tax, a description of what you're eventually going to supply, and the place of supply if it's an interstate deal. And why all this detail? Simple, because GST is payable on advances, so this document has to have all the tax info right from the start.
Okay, moving on. Let's cover some foundational principles, what I call the golden rules of GST invoicing. These are the absolute, non-negotiable rules you just have to know. This is rule number 1, and it's a big one, straight from Section 32 of the Act. If you are not a registered person under GST, you have absolutely zero authority to collect tax. End of story. Collecting tax without being registered is a serious offense, and it undermines the entire system. And golden rule number 2 from Section 33 is all about transparency. No sneaky stuff. You can't just give someone a price and say, tax included. The law says you must clearly and prominently show the amount of tax on your invoice and any other related documents. Your customer has every right to know exactly how much tax they're paying. All right, let's shift gears to something super modern and, honestly, a real trap for a lot of students: e-invoicing. This is a hot topic for exams, so let's make sure you don't make the common mistakes. This is probably the single biggest point of confusion with e-invoicing, so listen carefully. If you need to cancel an e-invoice, you do it on the IRP, the invoice registration portal where you generated it. But if you need to amend it, change a detail, no way. That is absolutely not possible on the IRP. Any changes have to be made on the main GST portal. Let me say this one more time because I see students get this wrong constantly. You cannot amend an e-invoice on the IRGP, period. Trying to do that in an exam answer is a guaranteed way to lose marks. Cancellation on IRGP? Yes. Amendment on the main GST portal. Please drill that distinction into your brain. Okay, let's bring it all home and connect the dots. After everything we've just covered, what do you think? Which single document that we talked about is the absolute hero for a brand new business, the one thing that prevents their customers from losing that valuable input tax credit? That's right. It's the revised tax invoice, right where we started. Keep these rules fresh in your mind, and you'll be in great shape. Good luck.